Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at unusual machines.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Yeah, let's do it. There's a lot to unpack here.
There is. We've gone through the reports, the announcements, everything. And the main story really is this pivot. They're moving from just being a hardware company to something much bigger.
The whole integrated platform, and the market is definitely paying attention.
Yeah.
To say the least.
Okay, so where do we start? Let's start with the money. That first ever profitable quarter, that's the headline.
It is. In Q3, they reported $1.6 million in net income, first time in company history.
Which sounds amazing, but you have to look under the hood a little bit.
Exactly. Because while that was happening, they also hit a record gross margin of 39%, which is solid for hardware.
But a big chunk of that profit, about $5.8 million of it, wasn't from selling drones. It was from unrealized investment gains.
Right. So the operational side is improving for sure, but the headline number is a little misleading.
It is. And that's why the balance sheet becomes so important. If the profit isn't all organic yet, you need cash.
And they have it. I mean, over $133 million in cash reserves. And the part I love, a debt-to-equity ratio of 0.
Zero debts.
That is just, it gives them so much flexibility.
It's monumental for a company that's trying to scale this fast. Now, you should know where that cash came from. It wasn't all from sales.
Right, the capital raises.
Exactly. They did an ATM offering, an at-the-market offering, back in October that pulled in over $72 million.
So just for you listening, that's when they sell new shares directly into the market over time. It means they diluted existing shareholders to build that cash fortress.
It's a classic growth company move. The question for you is it a sign of strength, or did they need that cash to fund their very aggressive plans?
Well, the revenue growth itself is pretty hard to argue with.
It really is. They're at $6.30 million for the first 9 months. That's a 55% jump from last year.
And the consensus estimates are for that to speed up, not slow down. Some are talking about maybe $21 million in revenue by 2026.
And that right there is why the valuation is where it is. But let's be clear. Despite that one good quarter, if you look at the last 12 months, they're still in the red.
Yeah, the trailing 12-month net loss is still around, what, $35 million?
Exactly. So Q3 was a great psychological win, but the trend isn't profitable yet. They've still got work to do.
Which I guess brings us to their strategy, how they're trying to fix that and build a real moat.
Right. It's all about vertical integration. They want to control everything, from the tiniest component to the software that runs the drone.
And the foundation for all this is still Fat Shark, isn't it?
It is. Which is, the undisputed leader in FPV video goggles.
And that's so defensible. Pilots are incredibly loyal to their goggle ecosystem. But, okay, so this new strategy goes way deeper than just headsets.
Oh, absolutely. Step one was locking down the supply chain. They bought Rotor Lab.
The Australian engineering firm.
Yeah, to bring all their motor design and prototyping in-house. That means they're not relying on third parties, and they can innovate much, much faster.
Okay, so that's step one. What's step two?
The software play. This is the real game changer for margins. They have a merger agreement with Aloft Technologies.
A drone software company. So why is that so critical for them?
It's all about the margins. I mean, their hardware gross margin is good, 39%, but it has a ceiling, software margins.
Way higher.
We're talking 60, 70, even 80%. If they get that right and bundle high-margin software with their hardware, it completely changes their profit outlook. That $35 million loss could disappear pretty fast.
So they're building their own parts and then layering super high margin software on top. And they're doing it all here in the U.S.
That's a huge part of the story. They just opened a 17,000 square foot motor facility in Orlando. Then they leased a massive 25,000 square foot warehouse.
This isn't just about efficiency, is it? It feels like they're positioning for something bigger.
It's for the biggest catalyst of all. Defense.
Let's go there. Because this U.S. manufacturing push, it's all validated by the defense angle. They're focused on being NDAA compliant. For anyone listening who doesn't live in the world of government contracts, why is that so important?
It's a giant barrier to entry. The NDAA, it basically blocks U.S. government agencies from buying drone tech from certain foreign countries, mainly China.
So by building everything here, they lock out the biggest low-cost competitors from the most lucrative contracts.
Instantly. The U.S. government becomes a captive customer. And it's already paying off.
The U.S. Army order.
A big one. The 101st Airborne Division ordered 3,500 NDAA-compliant motors and components that are also on the BLU UAS list.
And that BLU UAS list is another layer of trust, right? It's like a stamp of approval from the Department of Defense itself.
It's a massive stamp of approval. It proves their stuff is secure and reliable enough for the military.
And that wasn't the only one. There was an $800,000 order from Red Cat and a much bigger $12.8 million order from Strategic Logics.
Right, so they're leading in the consumer space and now getting these massive validations from the defense world. It's a powerful combination.
And they're not just stopping at drones, are they? That XTI aerospace investment.
Right, they put $25 million of that cash pile into XTI. Shows they're thinking bigger about adjacent markets.
eVTOLs.
Exactly. Electric vertical takeoff and landing. Think, the early days of air taxis. It's like they're buying an option on the future, where their motor tech could be used in much bigger vehicles.
Okay, this is a company moving at incredible speed. But that always brings risk.
For sure. And we have to talk about them. The growth is explosive, but like we said, the trailing net loss is high. Free cash flow isn't positive yet.
And core metrics like EBIT and EBITDA margins are still deeply negative.
Right. And for you listening, that just means the underlying business, before things like interest and taxes, isn't actually making money from its main job yet.
Yeah. Which brings up the biggest question for me. Execution risk.
Yes. They're scaling manufacturing, they're integrating Rotor Lab, and they're trying to merge with Aloft, all at the same time.
It's like building the plane while you're flying it.
It is. And if any of those integrations stumble, if the software doesn't mesh or the cost savings don't show up, it could really hurt them.
But the biggest elephant in the room has to be the valuation.
It is. The price-to-sales multiple is extremely high. Some data points put it around 59 times.
59 times sales. That's incredible. How can the market justify that?
Because it's not pricing today. It's pricing 2026. It's a bet on that massive revenue acceleration we talked about earlier.
So it's a pure growth trade.
Purely. Investors are betting the vertical integration, and especially that high-margin software will make it all make sense in a few years.
But if that growth disappoints even a little, a multiple that high,
Yeah.
it has no safety net. It's a long way down.
It is. It's a tightrope walk. But you have to say, institutional confidence seems really high. The stock has surged, and big funds are clearly buying into this story.
Okay, so looking ahead, what are the key things for you to watch over the next few months?
Well, you have earnings coming up, Q4 in December, then Q1 in mid-February. Those will show if the Q3 improvements were a fluke or a new trend.
And there's talk of a major purchase order, possibly in January.
Yeah, that could be a huge catalyst, especially if it's another big defense contract. It would validate this whole expansion.
Plus, you have the more technical market stuff like ETF rebalancing, which can move the stock around.
And then you get to the rumor mill, which is very active.
The uplisting.
Strong speculation about a move from the NYSE American to the Nasdaq Q. That often brings in more big investors and analyst coverage.
And the international rumors are fascinating.
Yeah, chatter about advanced talks with European defense agencies. If they can sell their secure U.S.-made components to NATO allies.
That would be a huge win. It proves their moat isn't just a U.S. thing, it's a Western alliance thing.
Exactly.
So when you put it all together, what does this mean for you, the listener? You've got a company with a really clear strategy, a ton of cash, zero debt, and some huge defense wins.
But the key takeaway for you has to be watching the execution. The whole bullish story, that entire high valuation, it all hangs on them getting the Aloft software merger right. If those 60% plus margins don't materialize, they risk just being another hardware company fighting for scraps. That's the whole ball game for the next 12 to 18 months.
You remember to subscribe and turn on notifications so you don't miss our next stock analysis. We'll catch you next time on Smart Wealth with Joshua.